What's going on, everyone? Today I'm going to be talking all about growth stocks. I'm going to be telling you my top growth picks right now, what growth stocks are, as well as how you can find these companies, and really just everything you guys need to know about growth stocks before getting into them. So without wasting any more time, let's go. Hey guys, welcome back and thanks for visiting my page. My name is Gagan Grewal for those of you who don't know. And like always, everything I say in my video is for entertainment purposes only. If you want to take it as education and grow your wealth, by all means go for it, but please be aware of your own risks. I have to make this very clear in today's video because I will be mentioning a few good growth companies that I like currently, but this is also changing all the time due to news events in the future, and as stock prices continue to increase, the companies become more and more risky. So anyways, let's get to the good stuff. Before I'm going to tell you how to find them, you have to know what they are and some things about growth stocks. So starting off with growth stocks and what they are, a growth stock can be any company that's taking advantage of strong and rising demands with longer trends that support the use of their products or services. So in simple terms, this means that they'll grow their sales and profits quicker than the average for the market. And usually when a company is going into a very fast growing sector, there will be lots of competition and rivals can easily disrupt their businesses, and these companies can follow just as quickly. But that doesn't mean that all growth stocks are risky just because some are. You have to compare what type of growth you are looking for. For example, some companies may offer 50% annual compounded growth rates, while some companies only offer 20. But even that 20% is a lot. So looking at, for example, Square. Square has a 3-year compounded annual growth rate of 43%. And they're in the digital payments company. If you guys didn't know what Square is, they help companies accept payments through debit and credit card transactions. So definitely check that out. And for example, Facebook, their 3-year compounded annual growth rate is only 24%. And I'm sure you guys all know what Facebook is, a social media company that owns WhatsApp, Instagram, and all the others. So there's a big difference between those two companies. And when people buy these growth companies, it's with the anticipation that they'll earn money through the capital gains. And when the stock goes up, they can eventually sell in the future. So, depending on what type of investor you are, whether you're a value investor, growth investor, or dividend investor, some of the things you guys should know is that these growth stocks usually do not pay any dividends as the companies are reinvesting their profits back into the business to help it grow at a faster rate. And dividends are just payments to shareholders like us for holding onto their shares. So some companies give away their profits every month, some give them every 3 months, some give them every year, and growth stocks usually don't give any at all. And these companies often look extremely expensive as well as trade at super high price to earnings ratios, but these can actually be cheap if the companies continue to grow rapidly, which will drive the share price up. And price to earnings ratio is a common ratio that's used to look at how companies are priced on the stock market at a very high level. I definitely wouldn't only look at this ratio and decide to invest in a company, but it'll be like one of the first few things that I look at, and it'll help me decide if I should even research this company a little bit further. So it tells us if the company is a little bit overvalued or undervalued. Also, keep in mind that this ratio won't even show up if you try Googling the company and they aren't making any profits. Because if the earnings are negative, then you won't have this figure, so it'll be even a little bit harder to value the company. And lastly, most or all growth companies will have some sort of unique advantage that allows them to grow at a rate that's quicker than the general market. This may be a unique product, or if they have access to some technology or resource that puts them ahead. So now that you guys know the basics to growth investing, let me show you a few stocks that I think will do really well in the future with a few points. And keep in mind, I'm trying to make these videos short, so if you guys want separate stock videos on specific stocks, please let me know in the comments down below and I'll definitely go in detail about some of these companies. So the first growth stock I'm mentioning is one of the safer ones that you guys can be invested in. It's called Freeport McMoran, ticker symbol FCX. They're a leading international mining company with significant reserves of copper, gold, oil, and gas. And the reason why I like this company is because copper is used so much already, and the need for more copper is going to skyrocket a lot faster than it can be extracted. So just looking at EV technology and the adoption of electric vehicles, conventional vehicles use roughly around 18 to 49 pounds of copper, while plug-in vehicles use 132. A battery uses 183, and an electric bus battery uses about 800 pounds of copper. So copper is essential to EV adoption and technology and its infrastructure, and the evolving market is just going to have a substantial impact on this company and the copper demand. And if you look at it right now, it's at $35 roughly, and at the beginning of the year it was around $7. So it's already gone up almost 400%. And I don't think this is going to slow down much. Even on their website, you can take a look. It says renewables are they're going to be using 4 or 5 times more copper than fossil fuels. Same with the electric vehicles. They also list out all the different ways that copper is used. It's used in everything from infrastructure, water supply, healthcare, to the food chain, to medical devices, 3D printing, defense, clean tech, communication, everything, right? So if you guys are investing into this stock, I don't think you guys need to worry that you guys will be losing all your money or anything like that. So I do believe that this stock will continue to appreciate. And in terms of valuation, FCX is currently trading at a forward price to earnings ratio of around 15, and its industry average is around 18. So it is trading at a little bit of a discount. So I would definitely take a look at this one. So moving on to the second stock, NIO, one of my favorites for sure. They sell electric vehicle cars in China, and China has the largest EV market in the world. It's already growing at almost 100% year over year with its deliveries, and of course it's easier to grow them when you're a smaller company compared to like Tesla, that's already selling like 500,000 vehicles. But NIO isn't showing any sign of slowing down, and they do have strategic collaborations with Mobileye for the development of autonomous vehicles, and they're creating more than a product for consumers of China. They're creating a strong brand. So they already have 3 vehicles out. This is their new sedan. They have their EC6. They also have their ES8. They have batteries as a service. So they're really trying to do it all, and I do think that NIO will be able to make it. It will take some time. They are a growth stock, and it will take some ups and downs. It does have a lot of volatility, especially right now. It's around $43. Its high was around 65, so actually 67, and so it's trading at least about a 30% discount from its high right now. So I'll definitely take a look at it if you guys haven't already. And last but not least, I also like the digital payment companies. I think they're really good to own, like Square and PayPal. But I personally like this SPAC, which is a special purpose acquisition company called BFT. They're going to be merging with Paysafe. Paysafe is a large payments company, and all these digital companies are accelerating the switch from cash to digital forms of payments by allowing businesses of all sizes to accept debit and credit card transactions. And the reason why I like BFT, which will technically will be Paysafe soon, is because they're going after a very different market, which is gaming. And I think this is one of the sectors that will be growing very rapidly, which will also help Paysafe grow. Second, and most importantly, Paysafe is valued at around $9 billion with over $1 billion in annual revenue. Compared to other companies like Square and PayPal, Square has $5 billion in annual revenues, and they're valued at $110 billion. So just looking at the valuation perspective, I think Paysafe has a lot more room for our shareholders to grow. So there you have it, guys. Those are my 3 picks that I'm taking a look at right now more closely. And if you like this video, please drop a thumbs up down below, drop a comment, subscribe, share it with a friend. And like always, I'll see you guys next time.